Hi everyone, this is Mehul Mehta and welcome back to my YouTube channel. So today we have a very special guest. He is none other than Gabriel. So just a quick introduction about Gabriel is he has more than a decade of experience, almost like 14 years of experience in risk management, and specifically his expertise in credit risk both in Basel and in IFRS 9. So in this basically in this video or in this podcast we'll learn more about how credit risk is done, how our credit risk model is done specifically for IFRS 9. So Gabriel has take out time from his schedule and he's super busy and really thank you for doing this, Gabriel. So he has taken out his some time just to showcase how credit risk models have been built for IFRS 9. So in this podcast, we'll learn from him. And now I'll pass on to Gabriel to share more about his background. And Gabriel, over to you.
Mehul. Really good to finally meet you. Yeah, I think we have been interacting on social media, LinkedIn, for a couple of while before we finally made this happen. Thanks for having me.
Sure, sure. Thanks, Gabriel,
Yeah,
for accepting my invite, first of all. And just for audience, Gabriel is super busy. We were trying to do this from a really long time. So finally, we have him on the podcast. So I'm sure you would all learn from him in today's session.
yeah, I try my best. Try my best. All right, yeah. So IFRS 9, yeah, IFRS 9 is a it's still a hot topic for jurisdictions that are on the IFRS standards. So IFRS is the international uh, International Financial Reporting Standard. Yeah, so it's governed by the IASB, which is the International Accounting Standards body. For most jurisdictions, in the US, the equivalent of IFRS 9 is the CECL, Current Expected Credit Loss, under the US GAAP accounting practices. I guess the focus today would be more on the IFRS 9 approach. Slight difference with CECL in the US. Yeah. So I have a couple of slides, perhaps to help us walk through non-technical slides, more of introduction to IFRS 9, if that helps. Okay, shall I share my screen?
Yeah, sure, sure, Gabriel. Yeah, really excited to look at the slides. Yeah.
Yep, can let me do that. Okay. Yep. So IFRS 9 ECL. So perhaps to take one step back, IFRS 9 is a very broad standard. It covers more than models, more than ECL. The broad categories under IFRS 9 would be classification of financial instruments, measurement of impairment, which is where the ECL falls under. So the measurement component guidelines under IFRS 9 is where we would cover the ECL, and it's a very big component. Under this measurement of impairment is where several guidelines are given by the IFRS 9 standards on how do we set aside what we call credit provisions uh, for credit exposures like loans. So some history about IFRS 9. I think this by now this is a pretty common story, but just to recap, is the IFRS 9 was conceptualized after the 2008 global financial crisis, some sort as a replacement to the existing accounting standard back then, more than 10 years ago, which was the IAS 39 accounting standard applied for measurement and impairment of credit risk. So the so-called IAS 39 was based on this what we call the incurred loss approach, where the credit provisions are only recognized when a loss is actually incurred. When a borrower like faces distress and goes into non-performing status, only when the borrower goes into non-performing status, then the credit provisions are recognized. So in the 2008 GFC, this was seen as some sort of a drawback of IS 39, which is it recognizes credit provisioning too late and too little. What it uh, what it means by too little, too late, which is a common narrative around the old IAS 39, is that if you only recognize credit provision at the point of default, and you book the provision when the borrower is already quite distressed, then you would see a huge spike in your credit cost. So you would see like no credit cost when the borrower is still doing relatively well, and then you would see a huge jump in credit cost when the borrower is experiencing distress, entering a non-performing status. So this jump is like a cliff effect, and if in the GFC, when you got many borrowers from a systemic risk point of view, you got a lot of borrowers jumping straight into non-performing, so that jump in credit costs, it caused like huge losses in a very short period of time. So that huge losses in a very short period of time became highly problematic, because it would eat into capital. The banks would have to scramble to raise capital, and so on. So that is where this too little too late came in. So moving on to IFRS 9, IFRS 9 recognizes the credit cost, which is the ECL, from the time the loan is originated. So whenever a borrower is onboarded, an ECL is already been booked. So you would see a little bit of ECL from the very beginning, and if the borrower experiences distress over time, then the provision is supposed, in theory, it's supposed to build up over time. So that is the supposed enhancement in credit provisioning approach under IFRS 9. So I hope this sets the context of why we have IFRS 9 today. It has been probably 7 years. IFRS 9 went live in 2018. So we are 2025. We are about 7 years in, where most financial institutions would have been on IFRS 9.
So basically, the difference that I observe is back then, when someone started facing loss or started, missing, maybe started incurring loss, that's when IAS 39 used to step in, right? But right
Yeah.
now, as soon as the loan is on the books, you have to calculate the losses, right?
Yeah,
Okay.
exactly,
Okay.
exactly. So, in a very simplified way of visualizing this, in the old standard, when the loan is booked, no credit cost is booked until the borrower experiences distress. It could be like 5, 6 years down the road, right? But today, the credit cost, the ECL, is booked immediately when the loan is booked, and it will stay on the books until the credit exposure is expired. So that's a key difference. So the how it is supposed to help in theory is that if you book the provisions early, and you recognize it early, then when the borrower goes into default, it is an incremental top up versus topping up a full charge of NPL some years down the road. So then that incremental top up is supposed to smooth out uh, extra credit provisions that might be booked a couple of years down the road, so that it wouldn't put a huge strain on profitability, wouldn't put a huge strain on capital. That's the idea. Okay, so moving on. to describe a little bit about the mechanism of IFRS 9 and how it allocates provisions. Under IFRS 9, we have this three-stage ECL concept versus a two-stage CECL concept under US GAAP. So how does the three-stage ECL concept works? Is that the ECL is allocated by what we call stage one ECL, stage two, and stage three ECL. So whenever a loan or credit exposure is onboarded, uh, the stage one ECL would apply first. So stage one ECL is calculated on a 12 months basis. So you would calculate like probability of default PD over 12 months, forward-looking horizon over 12 months that goes into the stage one ECL. So when a borrower experiences some distress and the credit risk of the borrower has increased significantly from the time the borrower onboarded. So we call this the SICR. It's a threshold called the significant increase in credit risk. So the most common way to visualize SICR is, for example, downgrade in credit ratings. So if you onboarded as a AAA exposure, 3 years down the road, you AAA borrower has been downgraded to say triple B or some threshold, then you would, by requirement, you need to move the ECL calculation from a stage one basis to a stage two basis, which is the lifetime basis. So moving from a 12 months basis to a lifetime basis, naturally you would see an increase in ECL being booked at the time of recognition of stage two. So that is it is supposed to help. How shall I put it? Incrementally topping up the ECL in case the borrower goes into default, which is stage three. So stage 3 ECL is the ECL allocated for non-performing borrowers. In most cases, the stage 3 ECL is not using a model, but it will be assessed on a case-by-case basis, especially for wholesale corporate borrowers. They are like special uh, teams looking at distressed clients. Normally, we call them SAM. SAM is Special Assets Management. So we have teams like SAM teams looking from a bottoms up perspective on how the recoverability is looking like for these defaulted borrowers, and based on the assessment of the recoverability, then ECL is allocated. But normally it might be quite big. So the migration from stage one to stage two to stage three is supposed to be incremental. So the whole idea is that we do not see a huge sudden jump, and we would see like a incremental jump in ECL. So that incremental jump is meant to reduce the strain on profitability pressure and strain on capital ratios. That's the whole idea of having this three-stage ECL. Under US GAAP, CECL, there's no stage two and stage one concept. If I recall correctly, the CECL is from the time of origination is always on a lifetime basis. So it's lifetime for performing borrowers, and if NPL, then it goes into non-performing status.
So basically, let's say if I'm a borrower, right, and if I apply for a loan, and like when I initiated the loan, I'll be categorized in the stage one ECL because let's say I'm a good borrower. So
Yep,
for me, when the bank calculates the losses, expected credit losses, it will be on a 12-month basis. But let's
that's right.
say, but let's say my credit score declined over the months or over the years, right?
Yep,
and
right.
uh, and the bank thinks that okay, now, because my credit risk has significantly increased. For me, it's better to put me into stage two ECL bucket. So now
Right.
instead of calculating the 1 year expected credit loss, the bank will calculate the lifetime losses, right? For me as a
Right.
borrower. Is that correct?
That's correct. That's
Okay,
correct.
okay,
Yeah, that's the whole idea.
okay.
Right. Yeah. So the definition of lifetime here is until the maturity of the loan. So for mortgage, lifetime can be quite long. It can be until 30 years. For certain short-term loans, it could be short lifetime. Some loans are even on a one-year basis. Yeah. So, but the key concept is stage two will be on a lifetime basis. Okay, so moving on to brief discussion on how we model ECL. So generally, we need four components to be able to calculate the overall expected credit loss. So we need the probability of default (PD). We need the loss given default (LGD). We need the exposure given default (EAD). And under IFRS 9, this is something unique. We also need the so-called forward-looking component. The reason for this is because under IFRS 9, the ECL is defined as in a expected credit loss that is unbiased and probability weighted across a range of scenarios with forward-looking information. What the forward-looking information is supposed to do is that it is supposed to embed any uh, outlook. So if the outlook is not looking good, but today, if the ECLs, if the default rates, if the PDs are relatively benign, we are supposed to adjust the ECL in such a way that it reflects the deteriorating outlook 1 year from now or 2 years from now. Yeah, so that's the idea under IFRS 9. So it's essentially trying to make the ECLs. Uh, I'm trying to look for a appropriate word, but let's say you're front loading the ECL in the future
Basically, yeah, how it
today.
will,
Yeah,
yeah, how it will look like. So forward-looking information is it like is it like having macroeconomic variables?
yeah, that's right. Yeah.
So
So
basically,
yeah, I have a slide on this towards the end, which we can discuss a little bit more.
mhm.
Yep. So just to recap, we need essentially four components to be able to calculate ECL. So the ECL calculation itself is not really rocket science because the term ECL, right, which is the expected credit loss, the definition of expected here is a bit broad, but one interpretation is that the term expected in the ECL can refer to the statistical expectation, right? So which means taking an average, lah, right? So when calculating average losses is basically the product of PD times LGD times EAD, right? And then we have the forward-looking information, lah. So the the product of PD, LGD, EAD gives us the 12 months ECL. And from a lifetime ECL perspective, the summation of the periodic marginal PD, LGD, EAD, forward-looking information, and because we are looking across a long time horizon until maturity, so we need a discount factor as well to discount the future ECL back to time zero, which is today. So that's this summation of the marginal ECLs would give us the estimate of lifetime ECL. And for discount factor, there's a very specific definition of discount rate under IFRS 9, which is using the effective interest rate. So when talking about discount factor, on a broad basis, we have a few options. We have like WACC, weighted average cost of capital. We have cost of equity, the cost of debt. So on the loans side, it is the effective interest rate by facility type. So credit card, for example, effective interest rate could be quite high because the interest rate charged on the credit card is quite high. The effective interest rate on mortgages might be different from credit card, might be a bit lower, right? So this is some important notes to be aware of the IFRS 9. Okay, so moving broadly to how we built IFRS 9 probability of default models. Uh, there are two areas to consider. So the first area is what is the starting PD, and then how do we extend the starting PD uh, to a longer horizon, so, such that we are able to generate what we call the PD term structure, right? So the starting PD is what we call the point in time PD. Uh, so this is a term that we might always hear within the IFRS 9 context. And broadly in general, we always hear terms like point in time PDs and through the cycle TTC PDs. So a little bit on this topic from a uh, regulatory capital Basel PD. These banks that are banks that have approval and are on the advanced internal rating based approach, the IRB approach, would already have a Basel compliant PD, which normally is more TTC. And since banks already have a PD model, a PD measure used for Basel purposes, uh, this Basel PD can be used as a starting point to uh, to get IFRS 9 point in time PDs. So most large banks, I would say, that are on IRB approach, they wouldn't need to reinvent the wheel by building IFRS 9 PD models from scratch. Normally, what they do is they would use the Basel PDs as a starting point, and they will make several adjustments in order to get IFRS 9 compliant PDs, which is the point in time PD. So, two approach is either we are starting from the Basel PD, or for banks that are not on the IRB approach for capital, then this this segment of banks would need to think of alternative ways to get the starting PD. So let's focus on the IRB side first. So if we are using the Basel PD, which is more TTC, then we often hear of this concept called through the cycle PD to PIT PD conversion. So you would need to convert the uh, Basel TTC PD into a more point in time PD. So what that means is that if you think about the Basel PD perspective, it is relatively more stable. So it is defined and calibrated on a more long run basis, such that it is able to withstand some cyclicality. But from IFRS 9 perspective, we need the PDs to follow the cycles, because that's by definition of financial reporting, right? So if today times are bad, then we need the PDs to reflect that bad condition, and if today the times are pretty good, then we need the PDs to reflect good times, versus the somewhere in between, which is the Basel PD. So how do we adjust the PD up or down, depending on the state of the cycle? Right. So this is where we have this concept of TTC to PIT PD conversion, and one of the most common approach, especially for the wholesale portfolio, is to leverage on the same underlying model that underlies the Basel IRB capital model, which is the Vasicek model. So the Vasicek model is a somewhat industry standard in order to convert a through the cycle PD, which is an input to the Vasicek formula. So you input a through the cycle PD into the Vasicek formula, and it also requires a view of what the cycle is today, which is the so-called Z factor. So the Z factor in the Vasicek formula will tell us whether or not we are in a good or bad part of the cycle. So I hope that that can give us
Yeah,
yep,
that
some
basically, right.
understanding, right?
Right, that basically clarifies. Okay. So initially, we started with, like, let's say, initially banks had Basel standards, so they also built like PD model for it. But that PD model is called the through the cycle PD, right? And now because
Right.
IFRS 9 came into existence, the
Mm.
calculation for IFRS 9 is more P point in time PD.
Yep,
So
that's right.
there,
That's
yeah,
right.
there has to be a way to convert TTC to PID, and that's why we use Check formula, right?
Yep. That's right. So to be able to use Vasicek formula, we need a cycle variable at the so-called Z, which is something to be modeled in the first place. So
Mhm.
for banks that do not rely on the Vasicek formula, one other alternative to get the starting PD, the starting point in time PD is basically to use the latest default rate. So the latest default rate is like a proxy for the default rate of the current cycle, right? So if today we are in 2025, we observe the default rate over the last 12 months. That's like a proxy of a starting point in time PD in the 2025 cycle, if that makes sense. Right? So this is not uncommon as well for banks that are not leveraging on the Vasicek formula. So that is the starting PD as as an input to a broader approach to generate the PD term structure. So the PD term structure would give us the lifetime PD. So one common approach to get the lifetime PD, and I've seen this across multiple banks. So I think is a pretty common approach, which is to have what we call a rating migration matrix or transition matrix, making use of the Markov chain. So I think the underlying assumption is that the properties of the Markov chain would hold. It has to be tested, but it is a common way to generate uh, the lifetime PD curves. So how this works is that we need a migration matrix or transition matrix of ratings. So you have a starting transition matrix of ratings of borrowers, let's say AAA. If today you're AAA, what is the probability you would remain in AAA 1 year from now? what is the probability you would get downgraded to double A, single A, triple B, and so on, right? And what if today the borrower is single A or double B? Then we are able to construct what is the rating migration across across time. Normally, is on an annual basis. So we get an annual transition matrix. What we can do with the transition matrix first is we can embed forward-looking information into the transition matrix, uh, and then making use of the Markov chain assumption, we can multiply the transition matrices together in order to generate a cumulative migration rates. So if we multiply two transition matrix together, we would get a 2 year cumulative migration rates. 3 year, we would get 3 year migration rates. 10 years, if you multiply 10 matrices together, we would get a 10-year cumulative migration rates. And from the migration rates, we are able to extract the default rates, which is the migration to the default status. So that migration uh, is a view of the probability of default. So this is how we are able to generate a what we call a PD curve. So the PD curve would be able to tell us what is the PD 12 months from now, what is the PD 24 months from now, 36 months, and up to um, the required lifetime for mortgage, for example, it can be 30 years, right? So I think uh, this is a common way for us to get the lifetime PD curves.
Also, Gabriel, I have a quick question. So you mentioned about like having, let's say, using the Markov's assumption to
Mhm.
have, to let's say, have the transition matrix, and when we multiply the, let's say, the components of matrix, we get cumulative PD. But
Right.
then those are cumulative PDs, right? But then how do we arrive at marginal PDs? Because I was reading somewhere that marginal PDs are more like quarterly PDs. Is that right? Or
A good question. I think it depends on the definition of PDs across individual banks. So when forming the migration matrix or the transition matrix, it could be defined on an annual basis. It could be defined on a quarterly basis. For banks that don't want to over-engineer things, then it can be on a forward. Sorry, it can be on a annual basis.
okay. And also, is there any other, are there any other ways in which we calculate, let's say, the 1 year PD into the lifetime PD other than the Markov's assumption? Are there any other ways we do like that we
So
follow?
there are other approaches. This is probably the most common, but the other approaches, they are simplified approaches. So the Markov approach under the migration matrix, it takes the rating migration into account, which is probably a bit more realistic. A more simplified approach would be to use what we call the survival formula directly. So basically, the year two PD would be one minus the default rate of year one, which is the survivors, and then multiply by a constant conditional PD, which you you might have made some assumption lah, as a constant. So then it becomes like a survival formula, and normally in this case the PD is always decreasing because the survivors are always decreasing across time. Normally this approach I've seen for like less material portfolios. So where you might not be able to construct a migration matrix. Maybe those portfolios are on standardized approach, for example. So it's not on IRB. You don't have an IRB rating. Then you apply this kind of approaches. And other alternatives to migration rates is a cohort approach. You could gather, let's say, 5, 6, 7 annual cohort of uh, of borrowers, then you can start to track them. So if your cohort is 5 years ago, uh, and you have all the default information, you know out of the cohort 5 years ago, how many defaulted 1 year from 5 years ago, and how many of them defaulted 2 years from 5 years ago, 3 years from 5 years ago. So you can start to draw a curve, right? And then of course the curve stops at year number five. Then you could apply some sort of curve fitting. You could fit some distribution, gamma, beta, uh, Weibull distribution in order to extrapolate what the year six, year seven, year eight points on the curve is going to look like. So that's something I've seen as well. So I guess these are options.
Okay. Thank you.
Yep, but good question. Yeah, so I think lifetime PD modeling is a very broad area. Yeah, so there's no one right approach. I guess the key to this is backtesting. So as long as your backtested lifetime PD is meeting, certain thresholds, it should be all right.
Okay. Got you.
Okay. So last but not least is the forward-looking information. So this one is also interesting. So the forward-looking models, in theory, ideally, it should be applied to all the components under ECL, which is the PD, LGD, EAD. Uh, but on a bare minimum basis, normally the forward-looking information is first constructed on the PD, which is to link historical default rates (ODR) to several macroeconomic variables. So, what it is meant to help with the ECL calculation is to get a forward-looking view based on a forward-looking macroeconomic projections. So we need to first build the model to tell us how the ODR is linked to, say, GDP, unemployment rate, or the inflation, for example, right? So we build the linkage model, which is the econometric model, and this takes a bit of time also because there are some limitations that through experience bank would face. Some portfolios have longer history. Some portfolios have shorter history. So if you have short history, like if your portfolio was only conceptualized, say 7, 8 years ago, you have 8 data points, and you want to build a regression model. How robust can it be, right? So I think these are some considerations to take note when trying to build this so-called forward-looking models, right? But assuming you're able to build it, and it meets certain requirements, like passing all the regression, the diagnostics, and the backtesting. So we have a linkage model, right? And then how the linkage model is used is that we need to feed the models the projected MEVs. What is the GDP forecast 1 year from now, 2 years from now, 3 years from now, for example, right? And normally it is not the credit risk quant. It's not a quant role to provide the macroeconomic forecast. So the forecast normally comes from economic experts. So within large banks, in the US or any part of the world, larger banks normally they have in-house research teams supporting their investment banking and capital market activities. They publish the research reports. So this team of economic experts normally is relied upon to provide the forecast or the projection of the MEVs required for IFRS 9. So
Um,
the quant's role is just to build a model, basically.
Right. Actually, Gabriel, so I was working at Regions Bank, and this was also one of my work basically. It was not like for this default rate, but more for CCAR defas. But I have a quick question. So is it something like this? Let's say we taken last 5 years, or let's say last 10 years of default. Let's say we are working on a mortgage portfolio, right? We are working on, so we have last, let's say last 10 years of defaults which has happened in our portfolio. And also, of course, we'll have last 10 years of different macroeconomic variables, let's say housing price index, new home sales, mortgage rates, and other, let's say, a bunch of other macroeconomic variables. So we try
Right,
to basically build a regression model between the observed default rate and, let's say, the macroeconomic variables, right?
right, right, right.
But then how do we get the forward-looking how do we connect the observed default rate with the forward-looking information? Like, how do we link that?
Oh, that is a really good question. I think it's not in my slides. So basically, the forward-looking information by leveraging on this regression models is that you would first feed in the macroeconomic variables, the projected MEVs. So you will arrive at a projected ODR. So if you recall earlier in my slide, we have the starting point, right? The point in time, the PDs. So the point in time PDs reflect the PDs as of today. The projected ODR reflects the default rate at some point in the future, right? So we need to connect these two. So there are two approaches that I've seen. One is to use the output of the regression models directly as a forward-looking starting point. The other alternative, which is more common, is to use what we call a forward-looking scalar. So if you take the projected ODR from this formula and you divide by the last known default rate, right? The latest observed default rate. So that gives us a scalar of how much the default rate would increase or how much the default rate would decrease. And then you apply this scalar on the starting PITPD that we saw in the earlier slide. So that embeds the forward-looking information into the point in time. So it makes the point in time PD point in time forward-looking,
Okay, okay,
essentially.
okay, got you.
Yep, good question. Yep. Okay. And last but not least, so earlier I mentioned that the ECL defined under IFRS 9 is supposed to be an unbiased, probability weighted ECL with forward looking information. So, what this means is that the ECL is supposed to um, be calculated across a range of scenarios. So the reason for this is to capture certain non-linear impacts on the ECL. So for example, if if we take only one part of scenario, let's say we only have a baseline scenario versus we have a baseline, we have a upside scenario, we have a downside scenario, and if we do a weighted average of this, the results may not be exactly the same. Yeah, so there's some the non-linearity in the weighted average approach. So the standards under IFRS 9 says that it has to take a range of scenarios so that the ECL would be unbiased. So um, from the operational point of view, what this means is that there are also teams within the ECL team to craft scenarios. What is the so baseline normally comes from like budget, right? But what is the upside looking like? What is the downside looking like? What is the best way to assign the probability weights on the scenarios? So this one is there's no model, right? So it takes a few rounds of discussion across a panel of experts to do this. And then once we have those, then we can do the weighted average to get the final ECL.
So is it something like, let's say we have three scenarios, the base scenario, the upside scenario, and the downside scenario, and
Right.
basically we calculate the ACL for all of those, and
Yeah.
then
Right.
we say that, okay, let's apply 40% weightage. Is it like a equal weightage that we apply, or like?
No, no, no. So that it's not supposed to be equal weight. So the weight is supposed to change based on outlook, lah. So if the outlook is not looking good in the next 1 year, then the panel of experts, in theory, it's supposed to put more weight on the downside scenario, lah. That's the idea.
Okay, okay. So we'll basically say, let's say W1, which is like, let's say the weight of, let's say, base, and we'll multiply the ECL of the
Right.
base, and then plus W2. which is the weights of upside, then ECL of upside plus weights of downside into ECL of downside, right?
Right.
Okay.
That's right. That's right. Yep. So I guess this concludes the introduction to ECL and its components, lah, PD, LGD, EAD. What perhaps I did not manage to cover is on what the LGD and EAD are looking like under IFRS 9. But just a brief description. So the LGDs under IFRS 9 is broadly similar to how LGDs are calculated under Basel. One of the key differences is that the recovery cash flows for the defaulters in order to calculate LGD should be discounted by AR. So that's one of the key difference. And also LGDs, in theory, should apply the forward-looking information as well, although it is not very common, especially for wholesale portfolios. So the LGD forward-looking is more common for collateralized exposures. You have a collateral, let's say a mortgage, right? So it's common to link projections of house price indices or real estate indices to the mortgage LGDs. But for credit cards, it might still find some linkage to unemployment. It's consumer based, but wholesale LGDs, the recoveries are all over the place. More often than not, you might not be able to find a good relationship, or you don't want to over engineer things. Yeah, same goes for EAD.
Perfect. Okay. Okay. So, okay. Yeah, that's so what's like the difficult part in, let's say, this whole ECL calculation? Is it like getting the data, building the model, or let's say doing ongoing monitoring? Like what's the most difficult part?
Good question. So I would say that the modeling itself, especially for banks that are relying on the Basel model, uh, the modeling is probably less complicated lah, compared to Basel models, capital models. So if we talk a little bit about, let's say, the capital modeling side, um, on the Basel capital, you need to build, let's say, a credit scorecard first, right? Then from the credit scorecard, you need to convert those into PD. So you you need like a score to grade. Score to PD mapping. So there's some calibration there to calibrate to the long run PD, the so-called central tendency (CT). So there's a lot of moving parts within the Basel PD, and the data is a lot more intensive because you need to collect factor level information. From a consumer perspective, you need to collect borrower information like what is his age, his income, his occupation. You need to link it to bureau data, FICO and all, right? All this may not be that complicated in the IFRS 9 sense because you are using the Basel PD as an input. So the heavy lifting has already been done, right? So what you need first is to construct a term structure, the Markov assumption, and then you need the regression model. So that is probably the bulk of the work within the IFRS 9 space. So the and then for a bit more sophisticated modeling, if you are using, let's say, the Vasicek formula to convert TTC, Basel input PDs, to point in time PDs. So you would need to model what a cycle may look like. So that requires a bit of modeling as well. So that might be something to be considered under the IFRS 9 space.
Okay, okay. And when we say forward looking, so okay, it's basically we calculate all the ECL up till the life of the loan, right?
Oh, that is a good question as well. So when we say forward looking, normally is up to the projected horizon available. So if the panel of expert economists can only give forecasts up to 3 years, so you have the so-called forward looking scalar up to 3 years. And post 3 years, then you would revert back to the so-called, you like a mean revert back to the uh, long run matrix lah, if you're using the Markov assumption.
Okay, okay.
Yeah, that's the idea lah. So basically, if you need to calculate ECL for 10 years,
Mhm.
right? So your forecast of for 3 years, so your matrix you can adjust it for up to 3 years. So you got three different non-homogeneous matrix, right? You can multiply them to get a cumulative 3 years. But in the fourth year, then you rely on the long run average matrix, and up to year 10 lah. So yeah,
So how
that's
do we get the long run average like PD? Is it like the 1 year PD that we calculated in the beginning, or like?
I was speaking more from matrix migration perspective. So it's how do we construct the matrix? So that might be also part of the challenge which you highlighted earlier,
Right.
right? So you need to construct a migration matrix. You need to select the right portfolios that you're going to apply this matrix. So it's a representation of the is this matrix representative for corporate, large corporate or mid market SME, right? Do you want to lump them all together to construct one matrix, or do you want separate matrices for those because their migration rates might be different, right? So all these are considerations, I guess.
Okay, okay, perfect, perfect.
Right, yeah. So I think just to recap, you need to collect like ratings data. So you need to go backwards, right? You want the single matrix to reflect a long run matrix,
Mhm.
right? So you need migration rates from I don't know, at least 5 6 years ago. So you need ratings data. So what was the borrower's rating 5 years ago, and then 4 years ago, did that rating shift from AAA to uh, single A, or triple B, for example, right? So once you get a migration rates across time for, let's say, 5 years, then you can basically average them up lah, to construct a single long run matrix that reflects a long run migration rates. And then what you would do is that first you would for the migration to default, which is the PD, you would need to include the forward looking information into the matrix. So this is where the non homogeneous matrix comes in, up to the forecast horizon, say 3 years lah. So you
Okay,
got a matrix A, matrix B, matrix C, which the starting is the same. You just adjusted it using different scalars for uh, for the PD within the matrix, and then for year 4, 5, 6, 7, then you would revert back to the single matrix,
okay,
right?
okay.
Yeah.
Perfect, perfect. Yeah, this was great, Gabriel. Like, I mean, amazing. I mean, a lot of people. I mean, definitely your experience shows it all. I mean, you have told everything in such a simple way that even someone who doesn't know it will get to know a lot of it.
I
So
hope
thank
so.
Yeah, definitely. I mean, great presentation. You broke it down so easily, in such a simple way. Thank you so much, actually.
But I have the caveat that that I simplified a lot for discussion sake. Yeah,
Okay.
but the broad information is there. Yeah, so
Yeah. Yeah,
hopefully it's useful for your audience. Yeah.
yeah, definitely. Thank you so much, Gabriel, for coming to the podcast and showcasing. I mean, sharing your years of experience in such simple way. So, thank you so much for joining in. Thank you.
Yeah. But happy to do this.
Sure, sure,
Thanks for having me as well. Yeah.
sure. Thanks, Gabriel.
All right. Okay. Okay. Yeah. Hope you have a good day. Yeah.
You too. You too.